If you're a high income earner, then you already know that taxes are your biggest expense. The good news is there's proven ways to reduce them just like the rich because they understand how to play the tax game. And in this video, we're going to discuss the 10 tax reduction strategies you can use to keep more of your hard-earned money and avoid paying the IRS any more than you need to. Disclaimer, I'm a periodontist, not a tax advisor, not a financial planner. Please seek the advice of your own personal one to assist you with your financial situation. And if you're new here, I'm Dr. Jeff Anzalone. Again, periodontist in Louisiana. I'm here to help you get out of the rat race with passive income. If you want to download my guide for passive income, you can do it with the link below this video. All right, so let's get right into it. Here are the 10 ways that high income earners can reduce their taxable income. Number one, you want to simply max out all of your retirement accounts. Retirement accounts like a 403b, 401k, that can help you pay less tax on your income, your active income. Now, when you contribute to these accounts through your job, it's not taxed until you take it out. And then every year that you contribute, your tax bill is actually reduced. After you retire, it's likely that you'll be in a lower tax bracket. So the money that you take out in retirement will be taxed at a lower rate than if you'd have paid taxes on them when you earned it. So for instance, if you're a doctor, you have a high tax bracket, then you're not taking money out of your retirement account. When you retire, if you're in a lower tax bracket, then you're going to be taxed on it less. At least that's what they tell us. Now, contributing the maximum amount to your retirement plan will help you save the most on taxes, and the lifetime tax savings are likely higher than the amount that you contribute. Number two, HSA or health savings account. Now, this is like a 401k in that it helps you save money on taxes and it lets your money grow without being taxed. But an HSA has an added benefit that you don't have to pay taxes when you take the money out to pay for health care. Also, there is no penalty for taking money out of an HSA after the age of 65, which actually could make it a better choice for somebody with a 401k in some cases. Now, these accounts are only available if you're enrolled in an HDHP or high deductible health plan. Number three, maximize your itemized deductions. Now, to get the most out of itemized deductions and reduce your tax bill, you're going to need to add up all of your eligible expenses and then compare them to the amount of the standard deduction. Now, the standard deduction is a set amount that actually lowers the amount of your income that you have to pay taxes on. We're in 2023, so for instance, in 2023, the standard deduction, if you're single, $13,850. If you're married, $27,770. Now, if you itemize your deductions and they're actually greater than the standard deduction, then you may be able to lower your taxable income even more. But research shows that roughly 90% of taxpayers, they don't itemize, and they just simply take the itemized deduction. Now, there are a few things that you can deduct, some of the more common things: state and local taxes, personal property taxes, real estate taxes, mortgage interest, any charitable contributions, medical and dental expenses, which can be expensive. Now, it's important to maintain records and paperwork for any cost you intend to claim as an itemized deduction. Number four, Roth accounts, Roth IRAs, Roth 401ks, etc. So contributions to these accounts do not provide an immediate tax benefit like you get over here with the traditional IRA or 401k. You get the tax benefit now while you're working. With the Roth, you don't do that. So you don't get an immediate tax benefit. But any money that's earned in the account is tax-free when you take it out, versus over here, when you take it out, it's going to be whatever your tax bracket is at that time, okay? So again, this means that while contributing to a Roth account, it may not reduce your tax burden currently in the current year. It may save you money on taxes when the earnings are withdrawn during retirement. Number five, tax loss harvest. Now, tax loss harvesting is a method that involves selling investments that have lost its value to offset capital gains and lower your tax bill. This is how it works. So assuming that you have two investments in your portfolio, one that has increased in value and one that has gone down in value. If you sell the one that has gone up in value, you're going to have to pay a capital gain on that particular investment. However, if you sell the depreciated investment, you're going to have a capital loss. This capital loss can be used to offset this capital gain and decrease your overall tax liability. So for example, if you have $1,000 in capital gains for selling an investment, and then you have a $500 capital loss, you're only going to owe taxes on the net capital gain, which in this instance is 1,000 minus 500. You're only taxed on $500 instead of the $1,000. All right. Number 6 is qualified opportunity zone investments. Now, if you sold an investment and you made a large profit, you may be able to put off taxes on that gain and have a portion of it actually forgiven if you invest in one of these qualified opportunity zones. Now, what is a qualified opportunity zone? This is actually an economically distressed community where new investments under certain conditions may be eligible for this type of preferential tax treatment. Congress created this program as part of the Tax Cuts and Jobs Act of 2017 to actually encourage long-term investments in these low-income urban and rural communities throughout the U.S. One of the major tax benefits of investing in a qualified opportunity fund investment is the actual deferral of these capital gains taxes that, again, you are going to get if you sell something with a profit. Now, this benefit allows a temporary tax deferral on any capital gains by investing those gains in one of these qualified opportunity zone funds within 180-day period of actually realizing the gain. If you have realized a capital gain from the sale of an asset or an investment, you can invest those gains in one of these funds and defer paying taxes until 2026. In addition, if you hold your investment in the fund for at least 5 years, you're going to get a 10% reduction. And if you hold it for at least 7 years, you're going to get a 15% reduction. Now, if you keep the investment for at least 10 years, you're not going to have any capital gains when you sell it. So this means you'll have to pay much less taxes on the original capital gain. Not a bad deal. Number 7 is real estate depreciation. Now, depreciation is actually a tax break that allows real estate investors to deduct the cost of their rental property over time. Again, the Tax Cuts and Jobs Act, it actually reinstated bonus depreciation, which allows investors to deduct a specific percentage of the cost of their property in the year that it was purchased. Now, you may or may not know that this benefit, bonus depreciation, is being currently phased out as we speak. So from 2023, last year, 2022, it was 100%, and then 20% each year. 2023, 80%, 60, 40, so on and so forth. After 2026, unless things change in Congress, it's going to be phased out. Now, real estate investors can take advantage of bonus depreciation by having something called a cost segregation study performed on their properties to determine which aspects of the building are dedicated, decorative, or detachable. Now, these items may be eligible for bonus depreciation in the year that they're purchased. Now, this benefit is estimated to be worth anywhere from 20 to 25% of the building's purchase price in that first year. Also, those who spend at least 750 hours in their real estate business, they're materially participating, and they don't dedicate additional time to another profession, they may be eligible for a real estate professional status. What is this, you say? Well, what's the benefit? Well, if you're a real estate professional and you meet the criteria, you are able to file your taxes as a real estate professional status. This allows you to offset your earned or your active income with any passive losses that you get from depreciation. Huge benefit right there if you can file for rep status. So it's not required to actually, some people think that you have to have a realtor's license to earn the status. Well, it's actually not required. And married couples, a lot of times, they choose to have one either non-working spouse or part-time working spouse obtain this real estate professional status while the other one works full-time in a high-paying position. Number 8, if you're a business owner, you can consider hiring your kids. Now, people who own their own business, they can actually lower their taxes by hiring their children. Now, you can put your kids on the payroll if they're old enough to legally work for your business. As long as the children are under the age of 18, you don't have to pay Social Security or Medicare taxes on their earnings. Basically, you don't have to pay payroll taxes on their earnings. Now, their earnings will be taxed at their own tax rate, which is usually much lower than their parents'. Now, to use this strategy, you must pay your children a fair market value salary, which is the same amount you pay a different worker to do the same job. Number 9, set up a donor advised fund. Now, these types of fund are a charitable fund that you can set up that allows you to decide how and when to allocate funds to charities. It lets you give money and receive a tax break in the same year. You can then decide how and when to give the money to the different charities. This means that you can get the tax benefits of giving to charity on your current tax return, but you can also choose which charities to help and how much to give at a later date. So with the donor advised fund, you actually get the tax deduction when you give the money to the fund, not when the money is given to the charities. So this can help you plan. So if you have a really big tax bill this year, you may want to decide to do it now, and then you can give to your charities in the future. And last but not least, either own or start a business. Now, as a business owner, you must pay taxes on your business profits, not on the total income, which occasionally will allow you to get more tax breaks versus being a W-2 employee. It's important to remember that tax deductions, they don't make your business more money. Instead, they just lower the amount of profits that has to be taxed. So for example, if you have a $1,000 expense and can fully depreciate it right away, you might be able to save around $300 in taxes, assuming that you're in a 30% tax bracket. But your business's profits for a year would actually go down by $700 because of this. Even though tax deductions can help you pay less in taxes, it's important to remember that they don't make you any more money. So if you have expenses coming up, you might be able to get the tax benefits of those expenses a year earlier if you pay for them in December instead of January. Now, the number one way to reduce your tax liabilities is by working with a qualified CPA who can help you identify which incentives and tactics may be the most beneficial to your situation. And one of the most unbelievable tax benefits is actually termed a real estate tax loophole. If you're considering investing, especially in Airbnbs and short-term rental, it's actually called the real estate tax loophole. It's amazing, and I want to tell you all about it in this video over here.